So here's a crazy situation. Chip stocks are having their best run since the dot-com boom. But it's happening right in the middle of all this escalating global conflict. It doesn't seem to make any sense. Or does it? It seems like the market is pricing in this kind of war premium, betting that this insatiable demand for chips is going to win out over, well, total destruction. But at the same time, it's slapping this huge geopolitical risk discount on TSMC, the company at the very heart of it all. We're going to explain exactly why that's happening and what it all means for investors.
To really get your head around the scale of what we're talking about, you have to start with this number, $3.34 trillion. Seriously, just let that sink in. At its peak, that was the market cap of one single company, NVIDIA. And that valuation, it's not just about them. It's really a stand-in for this all-consuming, world-changing demand for the chips that are powering this whole AI revolution.
And this brings us right to the central puzzle we're digging into today. We're witnessing this massive rally in chip stocks, the biggest we've seen since the early 2000s, and it's happening at the same time as all this geopolitical chaos. So you gotta ask, why is the market betting on insatiable demand over total destruction? That is the multi-trillion-dollar question we are going to unpack.
So here's our game plan. First, we're going to look at the bull case, the seemingly unstoppable AI supercycle. Then we'll flip the coin and dive into the bear case, a single geopolitical choke point that could bring the whole house of cards down. After that, we'll see how the world is responding with a trillion-dollar race, and then we'll get into how you can actually think about this as an investor, from the big-name titans to the hidden infrastructure plays. And finally, we'll wrap up with how to navigate all this volatility.
Okay, let's kick things off with Section 1, the AI supercycle. This is the thesis, the bull case, the incredibly powerful story of unstoppable demand that is fueling these absolutely record-breaking valuations.
This right here is the core of it. We're not just talking about hype. The demand is totally real. It's measurable. It's creating this huge wave of new AI products. And here's the really crucial part that makes it different from the dot-com bubble. These crazy high valuations are actually backed by staggering earnings. These companies are making an unbelievable amount of money right now.
And, the future looks even bigger. By 2029, the entire semiconductor market is projected to be worth over $1 trillion. So when you see these stocks rallying like crazy today, this is the future that Wall Street is pricing in. A world where AI is everywhere, and the demand for the chips that power it just keeps growing exponentially.
But okay, for every unbelievably good story, there's always a catch. And this one's a monster. So now we're going to turn to the dark side of the AI dream, the really uncomfortable truth that this entire trillion-dollar industry is built on an incredibly fragile foundation, a single geopolitical choke point. This is the question that probably keeps supply chain managers and military planners up at night. I mean, we all see the shiny new factories, the fabs, over in East Asia. But what are they built on? What are the hidden weak links, the secret ingredients that could make the whole system just fall apart?
And boom, this slide just lays out the hidden vulnerability. The US might not directly buy a lot of this stuff from the Middle East, but its entire tech sector is massively exposed through East Asia. Those chip fabs over there, they are critically dependent on materials from the Gulf. Things like liquefied natural gas for power, helium for cooling, and sulfur. Get this, 45% of the entire global supply comes from that one region. Without these materials, you can't make AI chips, period. End of story.
Now, to really see how this could all go wrong, let's just walk through a potential conflict scenario from Oxford Economics. Okay, so Phase 1, ceasefire talks in the Middle East fall apart. Phase 2, the U.S. Navy blockades the Strait of Hormuz. And then Phase 3, almost half of the Gulf's 20 million barrels of daily oil production just goes offline. And just like that, the lifeline for all those critical materials we just talked about is completely severed.
And this chart just brilliantly shows the economic carnage. An initial spike sends oil rocketing past $100 a barrel. If the conflict drags on, we could see $150. And a full, prolonged blockade, well, we could be staring at $250 per barrel. At prices like that, the entire global economy just grinds to a halt. And it takes that whole AI boom right down with it. That is the existential risk we're talking about.
So, when you're faced with a threat like that, how does the world respond? Well, that brings us to our third section, the great fracturing of the global supply chain. It's basically a $1 trillion race for every country to get technologically self-sufficient.
And that old model of a perfectly efficient, globalized supply chain, it's breaking. Nations just don't want their entire economic future to depend on the stability of some distant, volatile region anymore. They're all chasing this idea of semiconductor sovereignty. And it's happening in two main ways, what they call friendshoring, which is just moving your supply chains to friendly allied nations, and nearshoring, which is all about bringing production physically closer to home.
And governments are throwing serious money behind this whole shift. I mean, the numbers are just staggering. China is funneling over $140 billion into its own domestic chip industry. The US has its CHIPS Act to try and bring manufacturing back home. And the EU is aiming to grab 20% of the entire global market by 2030. This isn't just a policy debate, it's like a new space race, but for silicon.
So this global race, it creates a really fascinating dilemma for investors. I mean, how do you even play this? Do you bet on who's going to win the chip race itself, or do you bet on something else entirely? And that leads us to this great idea of a picks, shovels, and power strategy.
It's a really simple concept, actually. It goes all the way back to the gold rush. You might not know which prospector is going to strike it rich and find the most gold, but you know for a fact that every single one of them is going to need to buy a pick and a shovel. In today's AI gold rush, it just means investing in the essential but often overlooked infrastructure that makes the whole thing run.
So this basically presents two very clear paths for investors. You can go one way and bet on the titans, the NVIDIAs and TSMCs, believing that they're just going to keep dominating the chip design and manufacturing world. Or you can take the picks and shovels route. This means betting on the companies building the actual physical world around AI, the data centers, the cooling systems, the networking gear. Companies like Vertiv or Arista, they win no matter which chip designer comes out on top.
And when you really drill down, you see just how deep this ecosystem goes. You've got thermal management because these AI data centers run incredibly hot. You've got advanced networking to link all those processors together. And maybe most important of all, you have energy. The demand for power is so absolutely crushing that Microsoft is actually looking into building its own nuclear power plants. Think about that. For investors who want broad exposure without having to pick individual stocks, ETFs like the Power Infrastructure ETF, ticker POWR, offer a pretty diversified way to get into this space.
So, after all that, where does this leave us? Well, let's talk about navigating this volatility. And it all starts with a pretty brutal truth about how we investors tend to behave.
This quote, it just nails a brutal truth about investing. The fear of missing out, or FOMO, it's an incredibly powerful emotion. When a stock like NVIDIA is just soaring day after day, the temptation to jump in is immense. But this often means you're buying right at the peak of a news cycle, exactly when two huge risks are at their highest. Those geopolitical risks we've been talking about, and something called duration risk, which is just the simple risk that this AI boom might not last forever.
This slide perfectly sums up the whole conflict. You've got these two dueling stories. On one hand, the fundamental case is just incredibly strong. You've got amazing earnings, real demand, a true technological revolution. But on the other hand, the geopolitical case is honestly terrifying. A super fragile supply chain that's completely exposed to a black swan event that could happen thousands of miles away from Silicon Valley.
And so we land on the multi-trillion-dollar question this slide is asking. Is AI a story of insatiable demand that's just going to power through any obstacle? Or is it an industry built on a foundation that has a fatal existential flaw? For now, the market is clearly betting on demand. The question for every single investor out there is, do you agree